The difference with uranium is it's a nuclear fuel. So it is held under national security implications. There are treaty constraints. There are strategic vulnerabilities that surround its production and its sale. And it's important to understand what those are in order to understand how it's affecting the market and how it can affect equities as well in a very different fashion than commodities. So what I want to walk through here are 4 commonly overlooked geopolitical risks that do affect the uranium market directly. Now, despite the fact that uranium is mined in dozens of countries, it's important to understand that there are 3 countries, Kazakhstan, Canada, and Namibia, that actually produce 60% of the world's uranium. In fact, Kazakhstan provides 40% of the world's uranium supply. This type of concentration in production can create a lot of fragility when it comes to uranium supply. So this type of concentration creates a very fragile supply chain, and it can be disrupted quite drastically when we see things like export restrictions or military disruptions. We will see and feel that effect almost immediately in the markets. We actually saw this occurring in 2022, 2023, when a number of the transportation routes through Central Asia were disrupted. What this means for investors is that uranium supply is not globally dispersed. It's very clustered. And any sort of disruption to any particular producers is going to be felt almost immediately throughout the entire fuel chain. Now, the second point that one needs to understand about uranium is that it is subject to a number of national security protocols. Unlike other commodities like copper or zinc, uranium is subject to the Nuclear Proliferation Treaty, security protocols, bilateral trade agreements. And what all of this leads to is something we call market bifurcation. And what we are seeing is that it leaves the Western world, be it the United States, North America, Europe, find their fuel and negotiate their fuel sources differently from the Eastern world, where a lot of uranium and uranium fuel is being contracted or sent east to Russia and China. So we've already seen a number of procurement shifts in the market where the objective isn't about getting the best price. It's actually finding access to fuel, and not just any fuel, but to politically acceptable fuel. What this means for investors is that not all uranium is created equal. The origin of where this uranium is coming from is mattering more and more, where utilities are now having to make sure that they can contract with politically acceptable and obtainable sources of that fuel. The third important aspect of geopolitics is that it can trigger sudden and violent price movements. In 2006, 2007, we saw a uranium bull run that was triggered, quite frankly, from concerns over Russia and China supply security. We also saw production delays in Canada, and all of these things drove that bull run. More recently, we saw a great deal of market volatility stemming from the prohibition of Russian enrichment services and, to a large degree, some of their production. So keeping in mind that the uranium market is highly illiquid, and where we're only seeing 5 to 10% of the activity happening in that spot market, geopolitical headlines can be quite shocking to the system and can drive prices in a more robust manner than any underlying supplier demand curves. What we see in these cases are really oversized price movements that aren't necessarily based on actual loss of supply. What this means for investors is that geopolitics alone injects optionality into your decision making. News alone can actually drive prices more so than actual supply disruptions. The fourth point to be made here is a number of these geopolitical moves can actually create long-term structural changes to the uranium market, not just temporary headlines. More recently, we're seeing a number of countries rebuilding their own domestic enrichment facilities. We're seeing increased support over domestic mining and domestic supply over the typical importing that occurs. Case in point, we're currently seeing Western governments more supportive of developing domestic enrichment facilities. We're seeing them supporting domestic uranium mining and production. We're seeing them supporting different financial arrangements and different tax incentives to strengthen up their access to fuel. More importantly, now we're seeing these Western countries signing up longer-term contract with non-Russian sources. And remember, these aren't just business decisions. These are national security decisions that are being made to affect the supply chain for a long time to come. What this means for investors is that we are in the early stages of a longer-term reordering of the uranium market. Companies positioned in stable jurisdictions with compliant supply are going to see more than their fair share of value moving forward. So for investors, the message is really clear that if you're not factoring geopolitics into your uranium thesis, you're flying somewhat blind. The next leg up in the market may not come from drill results or the spot price. It may just come from a headline coming from the other side of the world. And if you find that interesting, I urge you to listen to a few more of these.